If you have a small account and you want to sell puts on SoFi, I'm going to show you how you can do it with just a small $2,000 account. Yo, what is going on, Premium Chasers? I hope you are having a God-blessed day today. Every single person that comments down below is going to get my 10 favorite cheap, quote-unquote, Ark Options Strategy stocks. Perfect for those of you that are on that smaller budget. So just drop a comment down below. I'll personally send that over to you, and hit that like and subscribe button. Do me the biggest favor of your day. But guys, today we're going to be specifically talking about SoFi, of course, and is it a good opportunity to start selling some puts on SoFi and walking through what the current premiums are and if it makes sense. So over to the shoulder, we are seeing the chart right now. I have my Bollinger Bands overlaid on here, as well as my 200 and 300-day moving averages. You can see our 200-day moving average of SoFi is 1420, right? And our 300-day moving average of SoFi is 1184. And we on the RSI, which basically tells you how oversold or overbought a company is, right? Anything above like 60, you're really getting into that overbought territory. You can see we've been over 70 for quite a bit of time now, right? We can see we're towards that top of that Bollinger Band, which usually is a good time to sell covered calls. But at the end of the day, no one knows what the market's going to do. Who knows? SoFi could be trading at freaking $30 next week the way it's been going. So with that said, if you have a smaller account and you're very bullish on SoFi for whatever reasons that you have for yourself, right, because you have to make your own financial decisions, I believe selling puts is the best way to get into companies at better prices, right? So currently SoFi is trading at 21.56. If we go over to a brokerage account, I'm using Robinhood right now. Most retail investors can just go out there and buy 100 shares of SoFi and spend, their $2,100. But here's a better way. While you can also collect some premium upfront, I'm going to show you two ways to do it. Right? If we go over to our options chain, click sell put, we are option sellers here, guys. Guys, we are not options buyers. We are slow, steady, methodical, right? We're selling a put and we can choose our expiration date. If I just go out next week, which I do like running weeklies on SoFi, because it's just fun. It's just a lot of fun. But with that said, what I'm saying is I'm willing to buy 100 shares of SoFi on August 1st. Now, this trade is very dangerous. Why is this trade very dangerous? Well, I'm glad you asked, right? Because SoFi has earnings on the 29th, okay? So that's a very, very big, right? Obviously, we could see, crazy things happen in the market, right? For example, American Airlines today reported great earnings, yet somehow dropped 8%, right? Like, it's just the nature of it, right? So usually you want to be careful with that, but you're usually rewarded for taking that kind of risk, right? For example, right, if you have a $2,000 account, and you said you're willing to buy SoFi for $20, right, in 8 days, right? 100 shares, that's $2,000 collateral, right? You'd collect $51 of premium, right? Let's toss this into our cash secured put calculator. All these are free for you. Download them in our Facebook group. A link will be down below in the description. You could see we're collecting a premium of $51 and putting up $2,000. That gets locked up for those 8 days. A 2.55% return on collateral. That's very high. There's a lot of risk there, right? Because especially earnings were just happened for it, which could send the stock back down to 15, 16. I hope so. But that's what you're essentially doing. You're essentially providing insurance and selling insurance, right? Now, obviously, the numbers that we're discussing, guys, these are all educational only. Their numbers will vary when you are looking at your brokerage account, okay? So weeklies on volatile stocks, it is a play, right? But there is a higher chance of, something going sideways, especially during earnings. So you have to be okay with that. One thing you can always look at is the delta. The Greeks and stuff, they're good to look at, but honestly, nothing will tell you what a stock's going to do. It just helps you build a thesis. In my opinion, a $20 put is only a 27 delta. That is insane. Let's just say call it 30. There's a 30% chance that SoFi is trading at $20 on the first. I personally think there's a way higher chance that it could be. I do think SoFi is due for a pullback. Now, is that going to happen? I don't know, guys. I'm not smart enough, nor do I have the resources to be able to even comprehend how this market works at times. It is there's obviously often does not make sense. But with that said, right, that to me is a big risk, a very, very big risk. But you could see the market is so bullish on SoFi, guys. Obviously, you guys know in our live portfolio, I have a 17.5 call that's expiring just here on August 1st, actually. And I'm going to be selling my shares and locking in gains at 17.5, right? Just because I think it's just too hot right now. And I do that on our live portfolio, which I do updates on regularly. Now, if you are going to do weeklies, you're definitely going to be more involved in your options selling and doing the whole Ark options and wheel strategy thing, right? So usually you're dedicating, 15 to 30 minutes a day, right? Checking your position, checking for any updates, news, earnings, et cetera, okay? But, right, if you are somebody that wants to be a little bit more passive in the sense of meaning like, hey, I just want to let everything go to expiration, or, I'll check my portfolio, real quick a couple times a week, and if I want to just be a little bit more involved. There's no right or wrong. People in our community, we have both kinds, right? So for me, I personally usually say start with the 30 to 45 days to expiration. Get your feet wet for your first year doing this, because again, I'm not a full-time trader, nor do I want to be, but this is a great strategy to really just focus on like buying low and selling high. Listen, I'm sick and tired of buying high, selling low, like the meme. I don't know about you guys, but I'm comfortable saying it. Drop that amen if you've done that before. But what we can do is go out but 30 days, or just go 29 days out. Right now, we can take a look at the options chain here. Now, for that same $2,000 that you would lock up, right? Like, and here, I'll just do a comparison here for you. I'll just copy and paste this. Again, you could download all this stuff for yourself. For your $2,000, right? For your $20 puts here, right? You can see our delta is actually a 31 here now. There's a more of a chance here that it happens, and you're collecting $88 of premium on this, right? So you're collecting a bit more. Now, you are extending this out. This was 8 days. This is 29 days. Which one should you do, right? That obviously is your decision. Nothing here on this channel is not financial advice. I'm not a financial advisor. Assume you're going to lose money if you listening to me. But for me personally, if I look at my own life, right? Because I love to trade, but I'm not going to do it at the expense of my real life. So for me, if I know I'm kind of going into more of a busy season in my life, I'll typically do my monthly. Because I'm getting a good premium, right? This is very high in my opinion. Getting a 4% return in a month is ridiculously high. I usually like to be in the deltas of 0.20 to 0.30, but I'm just showing you how you could lock up $2,000 if you really wanted to and get in on SoFi at $20 a share, maybe, okay? There are risks here, right? So what can happen with both of these trades? Now, the outcomes are the same. The first thing you can do is let them both go to expiration, right? Wait the 8 days, wait to 29 days, and like when you open this trade, like don't even look at anything, and then just open it up and then start, right? And then see what happened. Now, there's two things that can happen at your expiration date. Number one, right? In this case, let's say SoFi, right, is trading sideways around $21. If that's the case, your contracts expire worthless. You don't have to buy your shares. Your $2,000 is no longer locked up, right? It gets returned back to you, and you move on to a different opportunity. Fantastic, right? The second thing that can happen is you actually have to buy your shares, right? You have to buy them, right? Let's say you log into your account and SoFi's trading around $19. Well, you will have bought your shares for $20. So you're not going to get your $2,000 back. What you're going to be getting instead is you're going to be getting your 100 shares of SoFi with an average cost basis of $20. But that's okay in my opinion, because what we can then do is run covered calls on SoFi for a weekly or monthly, okay? Now, there are ways that you can micromanage your trades, okay? There are ways. I like to, check my portfolio every day, and I think most people should spend 15 minutes a day checking your portfolio. And what are you checking for? Well, let's assume, right, that you did this trade, this monthly right here, and every day you go into your portfolio, right? Well, what's going to happen, or maybe could happen, let's just go through a couple different scenarios. So let's say SoFi, has an incredible earning. Actually, let's say SoFi has a terrible earnings and shoots up to $30 because that kind of stuff has happened before in this kind of market, which is insane. But let's just assume whatever happens, SoFi shoots up to like $25, $30, right? It just continues this bull run. Well, your contract really starts to become worthless, okay? So the market, you would be able to buy to close your position early. For example, let's say you did this $29 29-day expiration, and let's say in 9 days from now, right? 9 days from now, SoFi's trading at $30. So I'll put $20 as my expiration now, or as my 9 as my expiration, because that's potentially as long as I held the contract. That's the way I like to look at it, right? And let's say the market is telling me, you know what, Pete, give us back $20. Give us back $20 of that premium that we gave you, and you can buy to close your position. You can get your collateral back and then move on to whatever it is that you want to do, Pete, right? So if that happened, I will just give them $20 back, right? I net 68. I'm keeping that $68, right? I'm that's given to me. I already collected the full 88 premium, but now I have to pay $20 back to buy to close my position, right? Now, if I do this, I get my collateral back. I get my $2,000 back to then go run the opportunity on something else, right? And my return is within my targets. Whatever your targets are, I don't know you at all. That's why nothing I talk about is financial advice. For me, all of these are way more risky. Me personally, I like to shoot for more like a 2 to 3%, even under, like honestly, a lot of times 1.5. I like to be a lot more on the safer side with my strike selection, okay? So all these are still very aggressive in my opinion. But you could see my expiration here, right, is 9 days now. I basically was able to close my contract 20 days early in advance, right? Now, I like to look at this annualized return because typically, if it's higher than this, then I will usually close it out if I have another opportunity to jump into, right? Now, it's not always going to be that easy. Let's say it's 25 days. 25 days out, right? And on the 25th day of your contract, it's saying, you know what, give us $20 to close out your contract, Pete, right? And you give us $20 back of that premium, right? I net 68 again, right? My collateral will be returned back, right? Now, obviously, my return is lower. And, I only have a few days left for this contract to expire worthless. And look at how much my annual premium actually dropped, right? So in this specific case, I personally, wouldn't do this trade. I would just wait the few days, right? And just let it get to expiration. If I get assigned, okay, it is what it is. The only time I would ever close something like this, if I truly needed this money to jump into a different opportunity. If you want to learn more about this, we have a private mastermind group known as the Option Seller School, which gives you all the resources you need to set up your option selling portfolio and have it actually fit into your faith, your family, and of course, your real life and your real responsibilities. If you want to learn more about that, you're not a toxic individual and you are financially stable, click the first link in the description of today's video. Guys, remember, sell options, collect premiums, repeat. I'll see y'all tomorrow.